If you own Nvidia, Micron, AMD, Broadcom, or any AI ETF, there is one stock you probably need to understand right now. And it is not an American company. It is SK Hynix. This South Korean memory giant is preparing to list American Depositary Receipts on Nasdaq. The company is raising about $28 billion, with trading expected to begin on July 10th. Now, here is why this matters. This is not just another overseas company trying to get more US investors. This could become one of the biggest tests of the AI trade in 2026. Because SK Hynix is not selling AI dreams, it is selling the memory that AI chips cannot run without. Nvidia gets the headlines, the GPU gets the premium multiple. But inside every AI server, high bandwidth memory is one of the biggest bottlenecks. Without HBM, the GPU is like a sports car with no fuel system. Beautiful machine, not very useful. And right now, two of Wall Street's biggest names are publicly disagreeing about what happens next. Morgan Stanley is warning the memory rally is approaching its peak. UBS is telling investors the real move is still ahead. I'll walk through both sides and show you where I land. So the question is not simply whether investors should buy SK Hynix. The better question is this. Is Wall Street about to reprice the world's most important AI memory supplier? Or is this exactly the moment when investors are being invited into the trade after the easy money has already been made? Today, let's break down why this listing matters and whether SK Hynix is still a real AI opportunity or already a crowded trade. My name is Phoebe, and you're watching Tradingkey. Same chip, different price tag. Let's start with the part most investors are missing. The SK Hynix ADR is not just about convenience. It is about market identity. SK Hynix and Micron compete in the same markets. In HBM, the high bandwidth memory that every AI server runs on, SK Hynix is clearly winning. Micron is still catching up. But for most of the past 13 years, Micron has traded at roughly 35% higher valuation than SK Hynix. Same industry, one company with the better product, and the market prices it lower. That gap has nothing to do with the business. It's about access. American investors can buy Micron the same way they buy anything else. Buying SK Hynix meant opening an international brokerage account, dealing with currency conversion, trading in Korean market hours. Most people just didn't bother. That friction matters, because when a company is hard to buy, it often trades at a discount, not because the business is worse, but because the buyer base is smaller. HSBC looked at this and made a direct call. They built the ADR listing directly into their valuation model and said, once this stock trades in New York, it deserves a 20% premium. That moved their price-to-book target from 2.8 times to 3.4 times, and their price target from the equivalent of roughly 2.9 million Korean won all the way to 4 million won. Once SK Hynix trades on Nasdaq, the same factories, the same chips, the same customers, but now placed inside the American investors' existing semiconductor framework alongside Micron, Nvidia, and Broadcom. That is where the re-rating story begins. And in markets, a new buyer base can be just as powerful as a new product cycle. The numbers Morgan Stanley isn't talking about. Morgan Stanley said SK Hynix and the broader memory sector are approaching peak rate of change. Prices are still going up, they said, but the fastest part of the rally is behind us. UBS came back swinging. They raised their SK Hynix price target and told investors this is a temporary shakeout. The real move is still ahead. Morgan Stanley's warning sounds scary, but let's look at what the actual numbers say. HSBC estimates SK Hynix's revenue will come in around 81.94 trillion won for Q2. Operating profit around 66.1 trillion won, up 76% quarter over quarter and up 618% year over year. 6 times what it earned in the same quarter a year ago. UBS is even more aggressive. Their Q2 operating profit estimate sits about 14% above Wall Street consensus. They think the market is still underestimating this quarter. The driver is pricing. DRAM average selling prices rose roughly 40% quarter over quarter. NAND rose about 50%. Combined with cost improvements from technology upgrades, HSBC projects SK Hynix's Q2 operating margin hits 65%. 6 months ago, that number was around 30%. On the forward path, UBS lays it out clearly. After Q2's roughly 43% quarterly DRAM jump, Q3 adds another 21%, Q4 adds 13%. The rate of increase slows, and that is exactly what Morgan Stanley is flagging. But prices don't fall. That distinction is everything. The structural story is HBM4. SK Hynix has already entered Nvidia's next-generation Rubin platform supply chain and completed its HBM4 design qualifications. HSBC puts SK Hynix at 50 to 60% of the global HBM market. HBM4 carries a 40 to 50% price premium over standard DRAM. The global HBM market is projected to go from roughly $40 billion in 2025 to about $196 billion by 2028, a 70% compound annual growth rate. And then there are the contracts. SK Hynix is signing 5-year supply agreements with hyperscalers, including Microsoft and Amazon. These lock in 60 to 70% of future shipment volumes and pricing. UBS's supply-demand model shows global memory demand growing at 36.2% in 2027, while supply grows only 19.3%. The shortage ratio widens from 8.1% in 2026 to 13.6% in 2027 and likely holds into the first half of 2028. Morgan Stanley is watching the macro cycle. SK Hynix is locking in a structural position before the cycle matters less than the contracts. Those are two different conversations. How this stock could run past the fundamentals. Even if you understand the business perfectly, the next few months for this ADR could be driven by mechanics that have nothing to do with earnings. There are 4 of them. The first is cross-market arbitrage. The moment SK Hynix trades on Nasdaq and Seoul simultaneously, professional desks set up operations to capture any price difference between the two. UBS estimates the convertible float could represent 15 to 20% of total share capital, approaching $200 billion in total convertible market value. TSMC's ADR averaged a 16% premium to its Taiwan-listed shares in June. That is what happens when global capital suddenly gets a clean on-ramp into a dominant Asian semiconductor name. When American sentiment runs hot and the SK Hynix ADR trades at a premium, arbitrageurs buy Korean shares and sell ADRs, compressing the gap. The result? Amplified daily moves in both markets. More trading volume, more volatility. The second is index inclusion. UBS calculates that SK Hynix is likely to enter the MVIS US listed semiconductor 25 index, the index tracked by the SMH semiconductor ETF. Under the 5% maximum weighting cap, that alone generates roughly $3.5 billion in forced passive buying. SOX inclusion adds another estimated $200 million. If SK Hynix eventually qualifies for the Nasdaq 100, UBS's total estimate for passive flow reaches $15 billion. Passive funds don't discuss valuation. They buy because the index says buy. The third is buybacks. SKHY, the controlling shareholder, currently holds about 20.5% of SK Hynix. The new share issuance from the ADR offering dilutes that stake below the 20% threshold. SKHY needs to maintain strategic control. To protect its position, SK Hynix is expected to launch a buyback program after July 10th and accelerate it over time. Management raising $28 billion from global investors while simultaneously buying back stock in the open market is a strong signal. The fourth is the liquidity upgrade itself. The largest sovereign wealth funds and pension managers don't worry about whether a stock is cheap. They worry about whether they can get in and out of a position at size without moving the market. The Korean market's foreign ownership limits and currency friction made SK Hynix impractical for many of them. A deep liquid ADR removes that friction. More permanent institutional capital means less volatility premium required, and that is another form of valuation improvement that doesn't show up in any earnings model. Buy, hold, or walk. My read is, we're not at the exit point yet, but the reasoning matters more than the conclusion. The near-term story is the ADR listing, the capital mechanics I just described, and a Q2 earnings beat that UBS is already calling above consensus. The medium-term story is HBM4 supply dominance and 5-year contracts that insulate revenue from spot market noise. The long-term story is the transformation from commodity memory manufacturer to the world's primary AI-specific high-bandwidth memory supplier. Morgan Stanley's warning is about macro cycle momentum. SK Hynix's story is about micro-level structural positioning. The time mismatch between those two frameworks is where the near-term opportunity sits. That said, 4 risks deserve genuine attention. Samsung is the most immediate threat. UBS estimates Samsung could reach 41% HBM market share by 2027, potentially overtaking SK Hynix's projected 39%. If that gap closes faster than expected, the pricing premium compresses. Valuation overheating around the listing itself is real. Sentiment events can push multiples above what fundamentals support. The stock already implies a 2027 price to book of roughly 2.7 to 2.8 times. A technical pullback after listing excitement fades is entirely plausible. Industry capacity expansion creates tail risk. SK Hynix is planning 200,000 wafers per month in HBM capacity by 2027. Samsung and Micron are also building. Simultaneous large-scale supply additions could shift the supply-demand math that currently favors sellers. Hyperscaler demand slowdown is the biggest unknown. If Microsoft, Google, or Amazon meaningfully cut AI infrastructure spending, the premium demand for HBM4 that underpins SK Hynix's entire margin story weakens fast. Watch those 4. Right now, none of them have materially changed. Until they do, the thesis holds. One question for you. Now that you can buy SK Hynix directly through the ADR, does that actually change how you think about memory chip exposure, or do you still prefer just holding Micron? Drop your answer in the comments. I'm Phoebe with Tradingkey. Subscribe for more breakdowns. See you in the next one.